Rob Kindler, Global Chair of M&A at Paul Weiss. Glad you kept that good title. Well done. Let's talk a little M&A. It's been a long time, and it's good to see you. First of all, this move up in rates, is it coloring at all your view of both the fourth quarter and next year? Too early to say. What impact will it have?
I actually don't think rates have that much significance. I mean, it does limit buybacks. I mean, the days of borrowing money to do buybacks is basically over anyway. And also, shareholders really don't want buybacks as much as they want M&A or organic, investment. And even rates for private equity aren't really the drivers of returns. The drivers of returns for private equity is availability of leverage. The difference between getting 6 times leverage, 6.5, that affects returns. 2% more for interest rates doesn't really affect returns.
But of course, these days they're having a harder time getting 6 times leverage too.
Well, yes, it's the general availability in the market, but not necessarily rates that affect returns that much.
Right.
So I don't really put this. I don't really put the slowdown as being attributable to interest rates.
Mm-hmm. That said, I do wonder if private equity is more on the sidelines now as a result, perhaps, of the availability of credit and the inability to get those leverage rates that they might have wanted in the past. Is that the case? Does it open it up more for the strategic side?
Well, I think there's a couple of aspects to that. Of course, you'll never underestimate the ability of private equity guys to find ways to do deals. That's the business they're in. So in a market where debt's trading below what they put it out as, they'll buy back the debt. But there's no question that generally PE, particularly dealing with public companies, has been muted. And I think that's partly because the stock prices are relatively high. I mean, if you're looking at the market now and trading multiples, even though the market's come down generally this year, the multiples are still pretty high. So it's very hard to do a deal for a public company.
So what are you expecting as this year comes to an end and we head into next year? Are things going to get busier in M&A?
Yeah, I do think so. What people are comparing everything to is 2021. That was the aberrational year with almost $4 trillion worth of deals. We're going to get back to a normal pace of M&A. This year was a little bit down more. There were more uncertainties in the market, the war and all of that, just more uncertainties for people acting. So I think we'll get back to a more normalized level next year.
One thing that we have talked about a great deal, and I think for good reason, is regulation, in particular antitrust regulation, the FTC, the DOJ. What are you hearing from companies in terms of their approach at this point, particularly given the losses the FTC has had of late in certain cases? Are they more willing to pursue things they might not have, let's say, even a year ago?
Well, there's a couple of aspects. In Europe, it's been pretty challenging to do deals for years. I mean, Europe was really more of a gating item than the U.S. Then, obviously, with the change of administration, it's become much more difficult in the U.S. So there are deals that are not being done because people don't want to take on the risk and time to do it. On the other hand, given what's happened in recent cases, I think people are emboldened. But having said that, as we get more into an election year, people may say, you know what, I'm going to see what happens in the election before I start something that really has any antitrust.
So it's still a gating issue.